Hello, this is Sheila, tutor for ACCA's Advanced Audit and Assurance at Elite International College. In this video, we will consider how to answer an audit risk or risk of material misstatement question when there is equity settled or cash settled share-based payment schemes. I will show you how to plan the answer and how to develop the answer to meet the examiner's requirements. But first, let's briefly revise the rules in respect of equity-settled share-based payment schemes. IFRS 2 covers rules on when a share-based payment expense should be recognized and how it should be measured. On recognition, IFRS 2 says that a share-based payment expense must be recognized when there is both a mutual agreement of the terms and a legally enforceable arrangement. In simple English, it simply means that a share-based payment expense must be recognized when the scheme is legally binding. For measurement, there's a formula, and I use the acronym SOFT to make it interesting and easy to remember. The four elements that are found in the calculation. So what does SOFT stand for? S is the staff who are expected to remain in employment at the vesting date. O is the options given to the staff. F is the fair value of the share options at the grant date. And T is time to vesting. And this could be 3, 4, 5 years depending on the terms of the agreement of the scheme. And it must be time apportioned if the options are granted midway during the year. So what are all the possible risks when there is an equity settled share-based payment scheme? On the area of recognition, the risk that the plan is not recognized. On the area of measurement, then you've got the risk that management have assumed that all options will vest and that nobody will resign before the vesting date. That's pretty unrealistic. Oh, there's no risk here because the options have already been given. F is the risk that the fair value has not been measured at the grant date but at some other date. And T is that the share-based payment expense has not been correctly time apportioned, especially if the plan had been established during the year or that it has not been spread over the vesting period. So what if the exam question says that the share-based payment has not been recognized? Then what are the points that you can include inside your answer? So on the area of recognition, you could say that there is a risk that management is still unwilling to recognize the plan. And on the area of measurement, you've got SOFT, and you've got these risks here that you mentioned. So you can choose any of these. But remember, the ACCA examiner is going to limit you to just 2 risks for one particular item. So we're talking about equity settled. Then you're only going to put down risk twice and develop the point for 2 risks. That's all. So you're not going to use all 4 of them. Marks will be limited in the exam. So let's apply this knowledge to an exam question called OAK. The question says to identify and explain principal audit risk. So the question starts by saying you're a manager in Maple responsible for the audit of Oak, a listed company, and you're about to commence planning the audit for the year ending 31 December 2011. So you're sitting for this exam sort of 3 weeks before the year end. Oak established an equity settled share-based payment plan for its executives on 1 January 2011. So please note your year end is 31 December, established on 1 January, so you don't have to time apportion anything. You can just take the expense for the whole year. 250 executives and senior managers have received 100 share options each, which vest on 31 December 2013. If the executive remains in employment at that date, and if Oak's share price increases by 10% per annum. No expense has been recognized this year as Oak's share price has fallen by 5% in the last 6 months, and so it is felt that the condition relating to the share price will not be met this year. So let's think about this in detail. It says no expense has been recognized. Question: should the expense be recognized? Yes, because an equity settled share-based payment plan has actually been established. I'm going to assume that it's legal, all right? And there is a risk that the expense continues not to be recognized. And what could be some other risks that you can recognize here? You can look at the measurement part of things. So what are they? On the area of staff, that the company is going to assume that no one is going to resign. They've got 250 executives here and senior managements who have received this 100 share option. So assuming that none would resign is a little unrealistic. So there's always a risk that the expense is going to account for 250 execs and senior managers. On the area of options, you don't have to worry about that. There's no risk there. And on the area of fair value, you could also include this inside your answer that when they measure it, they are going to use a date other than the grant date. And the time to vesting, that they have not divided it by the period to vesting. That's always possible. So how are you going to write out the answer? Well, I've got an exam technique which I call OMAREE for Audit Risk ROMM questions. And we always start by putting down a little bit of the observation. Observation means a short story taken from the exam question. You can also include analytical procedures here, but if you include analytical procedures, half mark will be given for every calculation that you make. But there are no marks for the observation. The reason why we put down the observation is so that we can give a little bit of information to the partner who is chairing this particular audit briefing meeting to give him an idea of what's going on before we go on to the accounting treatment. Then, of course, we've got to include materiality inside, because if the item is not material, we really do not have to consider it as part of our planning procedure. So make sure that it's a correct calculation and make sure that you put down your conclusion as to whether it is material or not. Do not put down items that are not material. Only include material financial statement items in your answer. Then we're moving on to the accounting treatment. So the accounting treatment, put down the relevant part there. If the issue is on recognition, put down the rules on recognition, or if the problem is on measurement, put down the rules on measurement. Then we're going to talk about the risk, and that's 1 mark each as well. And on the impact on the financial statements, that means that consequently something is going to be overstated, understated, or misstated. So that's how the exam technique is for this question and the related marking scheme. Just one point here, that the marks for materiality may be capped in your exam to about 3 or 4 marks per question 1. All right. Moving on to how we're going to write the answer. So following OMAREE, what we're going to start with a little bit of a story observation. So we've got the story here. On 1 January, options were granted to certain staff to vest in 3 years. No expense has been recognized because share price has fallen in the last 6 months. So since they said that it has not been recognized, then we're going to say that it should be recognized when the scheme is legally binding. And a fall in the share price is a market condition and should be ignored for the purposes of recognizing the share-based payment expense for the year. The corresponding credit is to equity. So that's the accounting treatment. So here there's no point on materiality because there are no numbers here. Remember, it has not been recognized. Then after the accounting treatment, we're going to go on to the risk. Risk here is that they are still unwilling to recognize it. So note the 2 points here, that in the story we say it has not been recognized. So then in the accounting treatment we're saying it should be recognized. And the risk here is that management is unwilling to recognize the share-based payment expense and the impact on the financial statements. Consequently, the share-based payment expense and the corresponding entry to equity is also understated. You will not get any marks for the impact on the financial statements unless you are specific as to whether it is understated, overstated, or misstated. So what are the other risks that can be included in your answer? On the area of measurement, you could say that the fair value of these share options should be based on the number of employees expected to exercise the option, and this expense should be adjusted each year to account for staff turnover, because it would be unrealistic to assume that everyone receiving the options is not going to resign. Then the risk here is management assume that everyone will remain in employment. Consequently, the share-based payment expense and the corresponding entry to equity may be overstated. So you could include that. That would be 1 set of points. So remember that there is a limit to how many points you can put down there for one question. So we've already covered it under recognition. Now we're doing under measurement, and that's it. Stop here. But just to let you know that there are other things that you can write on the area of the vesting period. You could also do that. Now, what if the exam question now brings in cash-settled share-based payment schemes such as share appreciation rights? Then how does that work? So let's just revise our IFRS 2 just very quickly on the area of recognition and measurement. So on recognition, a cash-settled share-based payment expense must be recognized when goods or services are obtained. On the area of measurement, the fair value must be measured using the share price at year end, which is different from equity settled because that would be the fair value at the grant date. So if the exam question says that the scheme has not been recognized, then what are the risks on the area of recognition? That they continue to not do that. The risk that they will not listen to the auditor, basically. And on the area of measurement, that they do not use the share price at the year end. So here we've got a question called DALI. It says you're responsible for the audit of DALI, listed company. You're planning the audit for the financial statements for the year ending 31 December 2015. In March 2015, a cash-settled share-based payment plan was introduced for senior execs. So please take note, March 2015 is midway during the year, and therefore the expense would have to be time apportioned. It was introduced for senior execs who will receive a bonus on 31 December 2017. The amount of the bonus will be based on the increase in DALI's share price from the date of the flotation when it was 290 to the share price at 31 December 2017. And on advice of the newly appointed finance director, no accounting entries have been made in respect of the plan. But details relating to the cash-settled share-based payment plan will be disclosed in the notes to the financial statements, and the share price projected to be 350 at 31 December 2015. So you can see here, no accounting entries. Should there be an accounting entry? Yes, the plan was introduced. So how are you going to write this out? We're going to follow OMAREE again. So we're going to have a little bit of the observation, the story in the exam question, that the scheme was introduced and no accounting entries have been made in respect of the plan. Then we're going to leave out materiality because there are no numbers here. Remember, it was not recognized. Then we're going to look at the accounting treatment. The liability in respect of the plan should be measured at the fair value of the shares at 31 December 2015 and recognized over the vesting period. The liability should be time apportioned since the scheme was introduced during the year. Being the first year that the plan is introduced, the same amount of the liability should be recognized as an expense in the SOPL. So that's the accounting treatment. And then we've got the risk that the finance director still be unwilling to recognize the share-based payment expense. Consequently, the share-based payment expense is understated and the corresponding entry to liability also be understated. Remember, the difference between an equity settled plan and a cash settled plan is that in the equity settled plan, the credit is to equity, whereas in the cash settled plan, the credit would be to liability. So that's it. It's really very simple. Practice writing it out. Practice your audit risk question using the exam techniques, and you'll find that you'll have a professional answer. See you next time.